This is Phil Gunn. I'm account manager with Phillip Futures. In today's webinar, we will be discussing how to get started in trading on the micro index futures. Before we begin, I would like to do a sound check. If you can hear me loud and clear, just type yes into the question box. Also, during the webinar, if you have any questions, feel free to type them into the question box, and I'll address them during the Q&A session at the end of the webinar. Great. Looks like everyone can hear me clearly, so let's begin tonight's webinar. Welcome once again, everyone, to the seminar, Getting Started in CME Micro E-mini Trading Index Futures with Nova. Due to the coronavirus, the US stock indices have taken a hit, but has since recovered after the immensely huge rescue package. Many investors are looking at US shares, and the US index futures can be a way to invest in the market over a broad basket of shares. We'll get into that really soon in a bit. My name is Phil Gunn, the speaker for this webinar, and I've been with Phillip Futures for more than 10 years now, since 2008. I hold dual license in futures and stocks, and I am an account manager to help clients trading in futures and Forex, as well as shares with understanding the product and market by providing coaching and economic information to make proper trading decisions. Investors are always looking for opportunities in the market, and I am very excited today to share on the micro index futures that are now offered for retail clients, especially in the sense of risk management, which is critically important when trading futures. Due to the size of the contract, this allows many more investors to be able to participate in this market in a way more suited to their profile. If you are a new investor, the first part of the seminar will serve as an introduction to explain the characteristics of index futures. For more experienced traders, we also have some discussion on the Fed activities at the end and its impact on the market. We will also look at the fundamentals for index futures. Throughout the webinar, you may have questions. Feel free to post them in the question box. My facilitator will arrange them and let me know, and I'll answer them during the webinar or at the appropriate time. This webinar will also be recorded and be put up for viewing at your leisure time. So just sit back and relax, get a drink, and enjoy the webinar. Before we start, just a disclaimer on the webinar today. Materials provided here is for general information and does not constitute a recommendation or solicitation to trade. The agenda. The topics that will be covered in the webinar is as follows. We will have a general perspective of what the product is. How does index futures work in general? After which, we will take a deeper look into the characteristics of each of the index futures. There are 4 basically, but we will be covering more on the popular S&P 500 and the Dow Jones. After that, we'll move into the calculations of the trades. In other words, to find out how the P&L works. We will then wrap up the first part with the reasons why we choose to trade micro E-mini futures compared to the other available similar products out there, such as CFDs and ETFs. The second part of the seminar will cover the fundamentals for trading index futures. What determines the long-term trend of the prices, the impact from the underlying, which is the earnings of the companies. This includes the economic climate and decisions from the central government and banks, which is reflected through the economic data that is released periodically. Lastly, we will then touch on a demonstration of Phillip Nova trading platform, if we do have the time, to let you have a feel of how the platform works. Without further ado, let's get started. What are Micro E index futures? The index futures is used to speculate the price direction of the index. The underlying is the stock index like S&P 500, Nasdaq 100, Dow Jones, and Russell. The two most popular are, of course, S&P 500 and Dow Jones. These indices basically tracks an underlying basket of shares which moves the index. So if you are interested in trading the stock market but you wish to invest in a basket of shares, the Micro E-mini Index Futures will be an appropriate tool for you to use. It is a relatively new contract, much scaled down from its predecessors, the E-mini Index Futures. This means the Micro E-mini is 1/10 the size of the regular E-mini. This enables more retail clients to be able to enter the market due to the smaller contract size. The risk exposure is reduced and better managed. The four index futures are traded on the US exchanges like CME, CBOT, and CBOE, meaning to say it's a fair open market where investors come to the central market to trade. The counterparty is not any single institution, but anyone ranging from financial institutions or retail investors all around the world. It is a huge market, estimated trading volume of 500,000 micro contract size daily across the four indices in the month of August 2019. Below, you can see the ticker symbols for the mini index futures as well as the micro E-mini index futures. Basically, the micro has a letter M in front of the ticker symbol. For example, the S&P ticker symbol is MES. Okay, let's move on. How does trading Micro E index futures work? Take S&P for example. So we are saying that we want to invest in stock market. You can actually use this to enter the market. Consider this as investing in the top 500 US companies, but you just need to buy one contract of the Micro E-mini S&P. Currently, the initial margin for one micro lot size of E-mini S&P is $1,320 US. So take for example, the S&P is traded at 2,850. You can enter the market to buy one lot of the micro S&P at 2,850 points, which has a notional value of $14,250 US. You can then wait and sell at a higher price when the index rises. For example, if it rises to 2,950 points, the notional value now becomes 14,750. This means that you will be able to make a profit of $500 from this trade without buying the actual shares. Hence, it is a pure speculation of the index by buying the index first and selling when it rises. This can also be done for the short side by selling the index first and buying it back when the index drops. But we will explain more on this for short selling later on. So there's no interest or financing costs on the positions, unlike other products like CFDs, which have financing costs on the borrowed margin or the leverage. As long as you come in with the funds of $1,320 for the required margin, which you can also substitute with the equivalent amount of Sing dollars, if you prefer, or about 1,900 Sing. But interest will be charged on this margin of 1,320 USD since you have the funds in SGD. You can convert the Sing to US dollars to avoid interest charges completely. This is recommended for the long-term positions, but for the short term, it is a choice whether you reduce the number of rate conversions. If you have USD funds, you can actually come in with the physical USD funds instead to avoid the interest charges. Other than that, there are no financial charges and you can hold a position as long as you want, but you will need to do a rollover every 3 months. For the commission, it will be $1.50 US per site per trade for the promotion period, which have now been extended to the 30th of December this year. This means for the round trip is $3 US, normally will be $6 US. This is easy to break even with 3 ticks. As there is a lot of liquidity, the spread is tight at 1 tick or 0.25 points. Let's move on to the S&P 500 index, or the Standard & Poor's 500 index, the most heavily traded contract amongst the equity indices. In fact, the top most liquid futures contract trading. Understandably so, as it tracks the S&P 500 index, which is a market capitalization weighted index of the 500 largest US public traded companies. It can be regarded as the best gauge of large cap US equities. Companies include Microsoft, Apple, Amazon, Google, Berkshire Hathaway, etc. Due to its wide coverage of the US stock market, investors who wish to invest in a basket of US shares may consider trading the S&P index futures instead. The next popular US index, the Dow Jones Industrial Average, or DJIA in short, measures the stock performance of 30 large companies listed on the stock exchanges in the United States. Comparatively to the S&P, many does not consider it to be an adequate representation of the overall US stock market compared to the broader market indices such as the S&P 500 index. The industrial portion of the name is largely historical, as many of the modern 30 components have little or nothing to do with the traditional heavy industry. Because it only includes 30 large companies, it is not weighted by market capitalization and does not use a weighted arithmetic mean. It is simply a price-weighted index. Even though it does not cover many companies, it's still a very popular choice among investors. The companies included are shown in the table. Companies include Apple, Boeing, etc. Just to highlight, Apple actually replaced AT&T in 2015 as one of the components. Next, Nasdaq 100 index, along with the Dow Jones Industrial Average and S&P 500. This is one of the 3 most followed indices in the US stock markets. Although it's Nasdaq 100, there's actually 103 listings, due to some of the companies having more than one listing because of the size of shares. The composition of Nasdaq Composite is heavily weighted towards information technology companies. The Nasdaq 100, whose companies are a subset of the Nasdaq Composite, accounts for over 90% of Nasdaq's composites movement, and there are many ETFs tracking its performance. It includes the FANG stocks, which stands for the 5 most popular and best performing American technology companies, namely Facebook, Amazon, Apple, Netflix, and Alphabet, which is formerly known as Google. These companies have a market capitalization of over $1 trillion each, or close to $1 trillion. Good. Now we move on to contract specifications. As you can see in this slide, the margin required for each of the micro index futures. Beside it is the mini index futures. Take for example the micro EMini S&P on the top left and micro Dow. The margin required is $1,320 at the moment. This means with just $1,320 or equivalent amount in Sing dollars, you can enter to buy or sell one lot. The smallest tick is 0.25 equals to US dollars $1.25. Since the commission is $3.21 USD for a round trip, inclusive of GST, that will mean that 2 ticks or 3 ticks will break even with a profit. The contract value is $5 times the index. So if the index of the S&P is at 3,200, will mean a value of about $16,000 USD worth of shares. So you only come in with a fraction of the value at only 1,320 US dollars. This means there's a leverage of 11 times. For the mini size, everything is just 10 times of the micro. For beginners, you can try out the micro size first to get used to trading it. You can also do multiple contract sizes if you find the movement too slow. Therefore, you can do 2 or 3 micro size to multiply the effect of each movement. Do take note that this applies if the market goes against you as well. So you can see the same principle applies to all the other contracts. Just feel free to come back to this slide later when you want to take a closer look. Now we move on to understand what the characteristics of the index futures are. First, it is a bidirectional market. Means you can buy for the upside and you can also sell first if you think the market is coming down. Then after that, you can buy back at a lower price to take profit. This allows you to short the market, unlike straight stop buys, which does not allow short selling. As shown, there are two contract sizes you can opt for: the micro size for controlled sizing, and the bigger mini size, which is 10 times bigger. You can do denominations of each contract as well. The initial margin required is about 9 to 11% of the contract value. You do not need to come in with the full value. This is the leverage of about 10 times. As mentioned, the margin at this moment for Micro Dow or Micro EMini S&P is $1,320 US. Since it is on leverage, there is a mark to market every day at Singapore time 5 a.m. This is based on the daily settlement price, which is released by the exchange at the close of the market. Based on this, it will determine your position if it is in the money, making profits. If that's so, you can still maintain the position. However, if the market goes against you, you need to top up the difference to hold the position. This is known as the margin call. I'll explain in detail in the next slide on the margin call. Next, the expiry is every 3 months. This means that the available months are March, June, September, and December. When it comes close to expiry, you need to close out the position to realize the profit or loss, or roll over to the next month to maintain the position. You only incur the commission charges for the rollover. There will be no financing cost or interest for this leverage. Okay, I hope you're following so far. We'll now proceed to the calculations on the Micro E-mini S&P, for example. As you can see here, the price shown here is 3005 bid versus 3005.25 ask. The contract size is one lot size. Margin required is $1,320 US, or about 11 times leverage. The smallest movement or smallest tick is 0.25, equals to US $1.25. Hence, you can also say, in other words, 1 point in movement in the index is actually equals to US $5. Let's just assume that we have $1,320 US in the account, just enough to buy one micro lot size. So assuming we buy one Micro E-mini at the market price 3005.25. Subsequently, we'll sell it at 3035.25. As you can see, the movement here is about 30 points. As 1 point is equals to US $5, that will equate to $150 US in profit. Hence, in your account, you see $1,320 original funds plus $150 US profit minus 6 USD commission, which will give you a total funds of $1,464 US. So this is an example of a profitable trade where you close out the position. Let's take another example where we hold the position instead of closing it out. Similarly, we'll look at Micro E-mini S&P for one lot size, and the margin requirement is still 1,320. 1 point movement is still $5 US, but now in the account funds, we have more funds than required. We have 1,500 US, which is more than the margin requirement of 1,320 US. So we'll buy one Micro E-mini again at 3005.25. However, this time we do not close out the position, and at market close, there's a settlement price where we'll mark your positions. In this example, the settlement price released by the exchange is 3020, which is in your favor. Hence, this is an increment of 14.75 points. Multiplied by $5 per point, it gives you $73.75 in profit. But take note, this is actually an unrealized profit because you have not closed out the position by doing a sell trade. Hence, it is still prone to subject to changes depending on the price that you exit the market. However, your account now is standing at $1,573.75. Okay, so these are the two examples for profit taking. Let's take a look for a margin call example when the market goes against you. Taking the same contract of Micro EMini S&P, and the amount of funds in the account is $1,500 still. So we'll still enter to buy one micro lot size at 3,005.25. And we did not close out the position when the market closes. However, this time the settlement price, instead of rising, drops down to 2,905.25. This is a drop of 100 points, which is equals to $500. So in the account, you have this unrealized loss of $500 deducted from your account funds of $1,500. This gives you a remaining balance of $1,000 in the account. Well, we have a margin call here because $1,000 is less than the 1,320 margin that is required to be maintained at all times. So there will be a margin call of $320. This is to be topped up by the second business day following the trading day. If you fail to top up by the end of the second business day, T+2, the position will be closed out and the profit or loss will be realized. So it really depends on the closing price when they close out the position. It can still turn into your favor on the second day and you will not need to close out the position. However, you have up to 2 days to do the top up. Great. I hope you're following the calculation so far. This is the first part of the seminar. Before we move on, let's take a 30 seconds break. Okay, let's have a summary of what we have gone through. The advantage of trading micro contracts is the control over risk exposure. Since the micro size is 1/10 the mini size, it gives investors control over the contract size they wish to enter. This allows more retail clients to be able to participate in the market. With the electronic trading online, it is a highly liquid market which is excellent for intraday trading. This means you can enter and exit the market quickly when it is volatile for a quick trade. There is no financing cost for the leverage, so you can hold a position without worrying for interest, as compared to CFD where there is a financing cost. Only thing is the margin which can be charged interest that can be totally avoided by coming in with the US dollar funds or converting the funds to US dollars. There is no counterparty risk and the done trades are confirmed as it is executed on a transparent exchange. Due to the high liquidity, the bid-offer spread is also tight. This makes it easier to break even with a tight spread. The round trip commission is low at $3 as compared to 0.28% on stocks. This is a promotional rate which is extended to December. The usual is actually $6. With round-the-clock trading from Mondays to Fridays, 6 a.m. to 5 a.m. Singapore time, you can trade on the go using a mobile or at night at home. You can close the trades whenever you wish when there's a profit. The weekends are closed because the exchanges are closed during the weekends. So it's basically 24 hours from Mondays to Fridays. As compared to other products like ETFs, which is only available in the day. This is good as a lot of movement is actually happening during the US hours in the night. Good, we have actually covered the first part of this webinar. Next, we'll move on to the key economic indicators, or the fundamentals. By that, we mean the economic data that is periodically released, which can be in a monthly or weekly fashion, that will give us an indication of the broad economic climate. Good, strong economic numbers will pave the way for the stock market to rise, as it acts as the strong backbone for the prices. On the other hand, if economic data is looking bad, you might want to be cautious and realistic on the potential returns of the upside. Of course, there are other factors such as fiscal and monetary policies that will impact the direction of the stock market. This has to be considered in conjunction with the economic data when deciding big trend directions the market is heading. We'll be covering some economic data first, followed by the monetary policy that has taken place during this pandemic. Here is a list of some of the economic data. Non-farm payroll. This is the number of jobs creation, basically, excluding the farm workers, as well as some government workers, private household proprietors, and non-profit employees. It's basically a monthly employment situation report monitoring the new jobs added into the labor market. One of the most important data that will impact the stock market greatly. Definitely the highlight to look out for every month. Earnings release. The butter and bread of the companies. This is the report filed by the individual public listed companies. The report basically shows if the company has been profitable in the past quarter and is used to determine if net cash flow is stable and profits are plentiful. FOMC, the Federal Open Market Committee, or the Fed, determines the state of the economy via data on employment and inflation and make monetary policy decisions such as moving interest rates. Its other tools in its arsenal include hefty asset purchases of bonds and debt securities. They has also released a monetary policy after the meeting, which states their analysis of the economy. Interest rate decision is more of a currency mover, but it's also very important as it is a statement on the economy's situation. CPI inflation numbers gives a perspective on the consumer side, as this is usually taken as inflation numbers. In general, volatile inflation numbers is bad for the economy. Inventory reports refers to supply report of the oil sector. There are reports for the US oil inventories as they are now becoming more important as a supplier of crude oil. Strong economy requires energy, which currently is still provided for by the oil. Lastly, industrial production, which tracks the monthly volume of industrial goods produced. This is also an indication of economic activity. So for the above indicators, it can be divided in two categories, lagging or leading. In other words, if they show before the economy takes the turn or after the economy takes the turn. A leading indicator changes before the rest of the economy and begins to go in a particular direction. It helps market observers predict significant changes in the economy. It is not always accurate, but used in conjunction with other data to help provide information on the future health of the economy. The lagging indicators is a measurable economic factor that changes only after the economy has begun to follow a particular pattern or trend. This serves as confirmation when the data is set in stone. In addition, lagging indicators tells the strength of the given trend. For example, a big GDP number or unemployment rate will show how strong or weak the economy is. So as long as you can see, economic indicators give a broad view, a long trend determination, so to speak. But sometimes during the release of data, it can show a reaction via short-term prices too. Hence, it's important to be aware of the timings of this data release, even for short-term traders, to practice risk management during the release hours. Next, we'll look at the first leading indicator, the earnings. A quarterly earnings report is filed by public companies to report their performance. Earnings reports include items such as net income, earnings per share. In short, whether the companies are making money. By analyzing quarterly earnings reports, investors can begin to gauge the financial health of the company and determine whether it deserves their investment. For example, the last earnings report on Amazon for the first quarter shows an increase in revenue overall at 75 billion, as highlighted. But the earnings actually dropped. You can see under earnings per share is in red 5.01, lower than forecast, which fails to meet or exceed the estimates published before the release. This may result in a sell-off of the stock. In many ways, analyst estimates are just as important as the earnings report itself. Looking at Amazon chart, after the release of the data on the 30th, you can see the stock price actually dropped from 2,475 to 2,315, which is a 6.5% drop. Also, the Nasdaq chart shows, which is the tech sector index, has dropped from 900 to about 875. Next, the EMini S&P chart has also dropped about 150 points as shown. The non-farm payroll. This is the monthly report for new jobs creation. It represents the number of jobs added or lost in the economy over the last month, not including jobs related to the farming industry. The markets react very quickly and most of the time in a very volatile fashion around the time of release of the non-farm payroll data. It is advisable to take caution for risk on trades during this day to avoid being caught in the wrong side of the market. The release is on the first Friday of the following month at 8:30 p.m. Singapore time. Typically, a non-farm payroll number will be good when it's above 200,000 jobs created. For the months of January and February, as you can see, the numbers were stable at above 200,000. After the coronavirus took effect, data for March was a drop of 700,000 jobs, followed by a whopping decrease of 20.5 million in April. For the most recent month of May, it was unexpectedly reported there were jobs added at about 2.5 million. Some states did start reopening, but it was a head-scratcher for many analysts. I'd like to take the example on the 3rd of April, the drop of the 700,000 jobs. As you can see on the non-farm payroll chart, on the 3rd of April, the EMini S&P chart dropped before the release of this market data, as market participants had anticipated the data to be bad, especially when initial jobless claim numbers were already foretelling. It rose after due to the Fed announcement of stimulus package we will be covering later. The 20 million drop in non-farm on 8th of May is also shown by the middle red bubble. This dropped 2 days after the data was released. For the last surprise increment, it is shown by the rising green candlestick. As you can see in all examples, non-farm payroll has a direct impact on the stock market in the immediate sense. Next, we move on to retail sales. It's also another thing to look out for, as when the economy is good, consumers tend to spend more. This brings more revenue to industries, which increases jobs and more pay. Hence, a cycle of economic growth. So this is one important thing that has to resume when normalcy of things comes back. This is reported on the 13th of every month, 8:30 p.m. Singapore time. The typical retail sales figure is generally not a big number with a single decimal growth every month. I'd like to use the example on the 15th of April. There was a drastic drop in retail sales of 8.7%. Taking a look at the chart of EMini S&P, it also dropped on that day from 2,794 to 2,744, about 1.8% drop. FOMC meeting, the most important indicator to look out for the whole market long-term directions. It stands for the Federal Open Market Committee. The tool it uses are interest rate decisions, which affects the borrowing cost of businesses. When the economy is doing well, lower interest rates will be introduced to alleviate the burdens of businesses. Another tool is to buy US government debt securities and inject the funds in the system to provide liquidity. The current interest rate of the US is at 0.25%. Let's take a look at the historical interest rates movement. In 2008, there was a Lehman crisis and bank bailouts. The interest rate was reduced from 3.5% in January 2018 to 0.25% by December. GDP for that year was negative 0.1%. Unemployment rate was pretty high at 6%. Thereafter, after the Fed kept the rate effectively zero between 2008 and 2015, and the recession ended in June 2009. Then into 2015, Janet Yellen has taken over Ben Bernanke as chairman, started increasing rates gradually by 25 basis points each time. GDP figures was positive at the time, ranging from 1.6% to 2.9%. By December 2017, interest rates have been increased to 1.5%, and inflation stabilized at 2.1%, GDP at 2.2%. FOMC continued to raise rates as the economy continued improving. With unemployment falling to 3.9%, rates reached 2.5% in December 2018. However, last year in July, Fed decided to decrease rates in view of the China trade war and slowing numbers. Then, after that, it was a pandemic, and they slashed the rates to 1.25% and subsequently to the 0.25% which we have now. Next, we move on to lagging indicators, GDP. GDP stands for consumption plus government spending plus investment plus net exports. Consumer spending is the biggest component, which accounts for 67% of, or 2/3 of the US GDP. Consumer confidence, hence, is a very significant bearing on the economic growth. This includes spending on goods and services such as groceries and haircuts. Government consumption expenditure and gross investment are government spending on equipment, infrastructure especially, and payroll. Investment is for the private sector, the domestic investment, or the capital expenditures. This includes investing in business activities such as buying machinery. And business investment is a critical component of GDP since it increases productive capacity and boosts employment. Net exports, calculated as total exports minus total imports. Developing nation typically has a GDP figure of 6 to 10%. The ideal for a developed nation is 2 to 3%. On 29th April, the GDP figures dropped drastically to negative 4.8%, worse than forecasted. Just before 2016, you can see this reflected as drop in GDP. Looking at the chart, you can see the drop is reflected also on the EMini S&P, which has a drop from 2,100 points to 1,600 points. Unemployment rate. Initial jobless claims is widely reported on the media recently, as it reflects in a weekly manner when people file for unemployment benefits. It has reached almost 42 million for over a 2-month period. Unemployment rate is starting to show this. The unemployment rate is a percentage of total workforce who is unemployed and still looking for a paid job. It rises in the wake of changing economic conditions rather than anticipating them. It's reported on the first Friday of the following month at 8:30 p.m. Singapore time. The ideal rate is to keep it between 4.5% and 5.5%. And the unemployment rate will be 3.7% in 2019. Current employment rate for the US is at 13.3%, which is expected to rise substantially to 20% region. As you can see here, it was dropping previously until the pandemic strikes. The spike was steep from 4.4% to 14.7%, and after that it dropped back down to 13.3% now. The actual values for the unemployment rate as shown. So you can see the unemployment rate is still very high for the US currently. Inflation measures and examines the weighted average of prices of a basket of consumer goods and services such as transportation, food, and medical care. Prices change associated with the cost of living. CPI is used statistics for identify periods of inflation or deflation. This figure is released every month on the second midweek. The ideal rate is around 2%. Currently, the US is undergoing deflation as consumer spending drops. The prices drop to entice buyers. Inflation has dropped to about 0.3%, which is slow. That is, ideal rate is to be maintained 2 to 3%. The Fed is also closely monitoring this figure to make decisions on interest rate decisions. On the CPI bar graph, you can see that in 2015, inflation was unstable. On the CPI chart, you can see the swings in the market during this period that was caused during the year of 2015. Here shown on the left is the release of timing for the CPI for this year. This is usually in the second midweek monthly. As of now, in April, the inflation rate is roughly about 0.3%, which is moving into deflation. Okay, we have covered basically the fundamental economic indicators. We now discuss what dynamic has caused and gone through in the recent months. As we know, all financial activities have come to a standstill. Initial jobless claims was clearly showing it, as the number of unemployment showed through this weekly report. By the second week of bad initial jobless claims numbers, Labor Department reported that another 6.6 million Americans had joined the ranks of the jobless. That meant that in just a 3 weeks period, more than 16 million Americans, or 10% of the workforce, had been sent to the unemployment line. To the naked eye, it looked like the US economy was in free fall, with no hope of avoiding the downturn that would rival the Great Depression. The Fed then jumped into action, of course. At literally the same minute the government released the jobless claims data, the Federal Reserve had an announcement of its own, which is a series of programs aiming at big and smaller businesses alike, as well as households and governments, representing an unprecedented $2.3 trillion in economic stimulus. The programs were far and away better and bigger than anything in the central bank attempted during the financial crisis in 2008 to 2009 efforts. The initial jobless claims still accumulates now, which stands at about 42 million people. So let's take a look at what the Fed has done. Looking at the events that have occurred since March, Fed acted pretty quickly by slashing the interest rates to 1.25% on March 3rd. The first case of coronavirus in US was in January. On March 15, another 1 percentage point rate cut was taken, taking the Fed's benchmark for short-term lending down to near zero. Soon after, Fed announced it would start buying commercial paper or short-term unsecured debt that businesses rely on for operational cash. On March 23rd, an expansion of the Fed's originally announced asset purchases, which was supposed to max out at $700 billion, but now has become unlimited, depending on the need to support markets and the economy. But the purchases at this point in time have already expanded the Fed's holding on its balance sheet to more than $2 trillion. On April 6th, the announcement that the Fed will provide support to the Treasury's Payment Protection Program (PPP), aimed at incentivizing businesses not to lay off employees during this coronavirus period. On April 9th, a $2.3 trillion lending program that will extend credit to banks that issue this PPP loan. Purchases up to $600 billion in loans issued through the Main Street program to medium-sized firms. The moves also involve secondary corporate credit facilities that will allow the Fed to buy corporate bonds from fallen angels that have slid down into downgrades, and a $500 billion program to buy bonds from state and municipal governments. In all the programs combined to provide more than $6 trillion of liquidity to the financial and business system. So it's a total of $6 trillion spent. Let's take a look at what happened to the EMini S&P during this 3 months period. As you can see from the chart, the events that occurred corresponding to where the S&P was at. The initial interest rate cuts paved the way to lessen the impact on businesses, but did not slow down the fall. The initial 700 billion worth of asset purchases also did not slow down the fall. It was only when the Fed announced an unlimited purchase that the stock market started to reverse course, as seen at the bottom of the chart, for a whopping 2 trillion on the balance sheet at this time. Later, to help small businesses, the PPP was introduced, as shown. The recent injection was then a 2.3 trillion lending program. Right now, despite the bad economic numbers, which impact the market momentarily at the time of release, the stock market is still rising. Why is that so? It seems that what happens to the fundamentals, or the corporate earnings, and economic growth doesn't matter. Because at this point in time, the Federal Reserve is buying. As long as the Federal Reserve is buying, the stock market will be supported. The stock market and economy does not always move in tandem, but the recent separation between these two has been especially stark. The end result is a growing divide between Wall Street and the Main Street. Okay, we have actually covered most of the information that we want to cover today. We'll now move on to the Phillip Nova Platform, which is a trading platform for trading on the micro index futures provided by Phillip Futures. It is a very user-friendly platform that can be operated on the web browser without installation. It is also on the PC or on the move using the Safari in the mobile. Everything is shown in the screen, so it also has charts included as well. We'll now take a look at the platform since we have some time. Okay, this is actually the actual platform for Nova. As you see here, on the top left is where the price codes are. On the top right is actually the trade menu, currently showing the market depth. And at the bottom is where your orders will be. So the flow is very simple. You start off by looking at the contract over here on the left. So the very top is the CME Micro E mini Index Futures, which is now ongoing, currently trading at 3,113 bid versus 3,113.5. Not moving much until the US starts opening later on. But yes, you can actually start trading now. So to start off the trade, simply just click on the contract and place order. When you have done that, it will show you the trade menu over here. So as you can see, the price is reflected over here. The quantity is 1 micro lot size, right? The order type will leave it as limit order. Typically, this is the order type used to enter the market or to take profit, right? So you can just click buy and sell accordingly. And the price, of course, has to be entered, right? So let's say you want to queue for a price at 3,100 at a lower price, you can do so by changing the value over here. And you can click buy or sell. Once you have done that, it will flow into the working orders menu over here, right? And completed orders will be shown under the completed orders tab. So as you can see here, information on top on this line, the CME EMini S&P, this is the mini version, not the micro version, right? Which is cancelled. This order is actually the EMini S&P also is filled, right? Quantity, how many lot sizes, and what price is it. So everything is shown very clearly on the completed order sites, right? So the flow is very simple from the top left to the trade menu until the orders over here. Just to show you a quick one on the charts and how it looks like, you can do so by clicking on the contract and clicking on the chart. And this shows you the intraday chart for the past 3 months, right? So for intraday trading, you can also change the time frames accordingly, right? So due to time constraints, I will just cover that and stop on the Phillip Nova. Okay, we have covered actually the Phillip Nova platform already. Before we come to the questions, let me just wrap up first on the personal services. We have almost come to the end. I hope you have found the info useful. Let me just touch on the available services offered by Phillip Capital. If you sign up for the account which is available online using my code, I'll be providing WhatsApp economic data updates every week to you. There will also be the technical discussions on trades, which I'll be assisting you with any questions pertaining to you and your trading account. I also provide technical analysis coaching for those interested after the COVID-19 situation subsides. When you have an account with us, we provide some services such as the Trading Central Research Portal, which is an in-house analyst reports, which emails the technical reports on suggested levels for your reference. This will be on each of the index futures to assist you in making decisions on the technical aspect in entering at better levels. We also have the daily commentary update. For fundamentals, we have commentary reports to give you updates on economic news happening around the world every day. This will keep you abreast on the latest economic news that might have potential impact on the markets, saving you the work of searching for it on the internet. Hence, we provide both the fundamental and the technical aspect of trading information to you, and you can have a platform ready to enter the market whenever you're comfortable. To open an account, you can open the account online via the link shown. Kindly just indicate my code ZGW on step 3 of the application form if you wish to have me as your servicing broker. The account opening requirements is a quick process that be completed in 20 minutes. If you prepare the soft copy of NRIC and bank statement, you can scan the QR code which is tagged to me shown on this slide. Simply select use my info or the SingPass for a quick submission. The deposit required is 500 Sing dollars for account opening, which can be funded later only, not during the online submission. This can be used for trading as well. To trade US indices, there's a promotion now at $1.50 until 30th of December. So it is a good time to start trading since there's a promotion going on. The contracts covered are applicable to all the index futures shown here. Well, just a quick touch on another promotion, an 88 referral fee for your friend who already has an account with us. You can tag him on account opening, and as long as you do one trade within a month of opening, your friend will get an 88 referral fee. Finally, just feel free to send us a feedback by scanning the QR code, and I'll see if we have any questions right now. Yes, we do. So one of the first questions, can I hold on to the micro contract on a longer term? Is there any interest or other hidden costs for trading micro contract? Okay, to answer the first question, yes, you can hold on the micro contract size in the long term or short term as long as you wish, right? But one thing to note is there's a rollover every 3 months, meaning to say you have to close off the current month and open a new position in the forward month. So the months traded are 3, 6, 9, 12. Every 3 months you have to do this, and the only cost incurred will be the rollover cost, which is the commission cost. Other than that, there's no financial cost for the leverage as mentioned, and interest. Yes, there's one potential small interest on the margin required, which is for one contract size on 1,320 US dollars. Is relatively small. So I would say if you really want to hold it for long term, it's not a big deal as it does not impact the P&L greatly. But you can also totally avoid that if you're holding large margins by coming in the US dollars funds or converting the Sing into US dollars funds. So to answer that, you can totally avoid financial charges by coming in with US dollars funds for long-term, very long-term positions. So yes, you can also hold a micro contract on a longer term basis by just performing a rollover every 3 months. So the next question, is there a quick entry and exit button for orders in Nova? Currently, there's no one-click trading, so you have to go through the trade menu to submit the order. Yeah, that's a good suggestion. I will highlight it to management on this part. Yeah. So do we have any other questions regarding the Nova or any part of the seminar? We still have a bit of time. Yes, next one from Mighty Look. Are there charges for maintaining account? All right. To open an account is 500 Sing dollars, which you can actually withdraw after opening or use it for trading. So there's no charges to maintain an account. Once open, you have access to the live price, but take note it's only for 2 months. If there's no trading, after 2 months, they can remove the live price, but you can subscribe for it again after that. So it means to say it's good to have the account standby ready at no maintenance cost at all, as long as you wish. And when the market is right properly, if the price index really drops a certain value or is dropping continuously and wish to short the market, then you're ready to go. So there's no charges for maintaining the account. Next question, is there a market maker behind this? What is Phillip's role in this? Okay, that is the beauty of this product. That's why it's traded on the exchange. For Phillip's role is just a broker at the middleman. We link you to the open market as international. So all the contracts are all traded in this centralized market online, right? Anytime you wish. So your counterparty is not a single market maker, because no one can really actually move the market except probably Fed might be able to do it, but we do not know. So it can be institutions or retail clients or any financial institutions or banks or anybody, but we do not know. But it's open and fair market. So Phillip does not take position against you, right? Your counterparty is actually any of the investors out there that's trading globally on this index exchange, which is actually the US trading exchange, right? So so it's not to worry. It's a very fair and open market that Phillip has as a middleman in this transaction. Okay, probably we'll take one last question. Transactions in US dollars. Yes, if you refer to the beginning of the seminar, the breakdown 0.25 equals to $1.25 US movement. So the P&L is all calculated in US dollars. Yes, so there's an exposure to the US conversion rate, or you can withdraw in US dollars, no problem. So because it's a US index, the P&L is all in US dollars. So if you want to withdraw in US dollars, you can, and you can also withdraw in Sing dollars after conversion. By the way, we offer a very good rate for conversion with Phillip Capital, as we are doing the Forex as well, which offers very competitive conversion rates for the interest. All right. Okay, I think just one very last question. What's the difference between Nova and the MT5 platform? Okay, as the topic today is on the futures, we are trading on the Nova, right? So as you can see, Forex is not available on this Nova. To trade Forex, which is currency, you have to go to the MT5 platform to do it. So basically, these two platforms are for different products, right? The Nova platform is for futures trading, basically, and the MT5 platform is for Forex trading, right? So they are separate, and the funds are actually managed separately. However, you can actually transfer internally between the Nova account and the MT5 account by just dropping an email. All right, we've covered the questions as well. So let's see. This is actually my slide to get in touch with me. If you're interested, just scan the QR code on this slide to get in touch. Finally, that's all the time that we have for today. Thank you so much for being such a wonderful audience for tonight's webinar. A link to the recording will be put up shortly, probably take a day or two, and this will be made available on our Phillip Futures website, also by a follow-up email to you by tomorrow. If you have any queries on the webinar or you would like to get started, simply reply to our email and we'll get in touch with you. So this is Phil Gunn signing off, and have a good weekend and evening ahead. Thank you.